Joining me today to discuss benchmarks in robotic trading is information technologist from Stash GmbH, Bernhard Schicht. Bernhard, first of all, what makes an effective trading strategy?
Sam, thank you for asking. It's a very good question because a strategy is based on a profit and a loss, and hopefully the profits are higher than the losses are. And so to find out the ratio, we have to go into some statistics. Otherwise, we just look at a profit and then we don't know what risk we undertake. So actually, these two are the most important topics in a statistic of a strategy. If you take the drawdown, for instance, that's the first one. It tells you in the past how much you might have lost if you were invested in a strategy from the very top to the very bottom in a timeline. And if you know this, you know your risk. Then you look at the profit, and it normally goes per annum, profit per annum. And if you see it at a very high volume, let's say 10, 20, 30%, and if you see the drawdown like a very small volume, like 10%, you might have a good strategy. And so there are many other strategies. They pretend to be very good, if we speak about this later. So we have to look at more statistics. And there's something like the profit factor, which counts all the profits and divides it by all the losses in the currency. And what else? We have like a win line of consecutive wins, and we have a loss line of consecutive losses. There's also a Sharpe ratio. We can measure a strategy, and many, many more. And really, to look through everything of them, it's quite difficult.
Yeah, so you speak about it being quite difficult, in fact overwhelming sometimes, because more statistics is fine in theory, but how can you identify what's going to get you an effective strategy, essentially?
Yeah, what we do mainly is we take the drawdown and we take the profit per annum. And normally you can make there's one incident drawdown and there's a long profit line 1 year. But still, you can make a ratio out of it. You can say, okay, let's take the profit divided by the drawdown. So if this is a positive number, let's say profit is 50% and drawdown is like 10% of your equity, then you have a factor of 5, and that is a good one. So that was the first measurement of a good strategy. And then you can look deeper into the system and see all the other parameters, if they are, is a good profit factor, or is it is a bad profit factor? Is it just one trade, or are there many trades? And so you can find out the good ones and the bad ones.
Okay, so let's say you've identified a good one, or you feel you have, and the statistics seem to support that. How can you be sure that it potentially isn't a scam strategy?
Yeah, scam happens very easy because there's a lot of money involved in this area we are working in. So people like to pretend to be a good strategy, and what they do just a few trades, and they show you like nice profit line, no drawdown, and then they kind of stop trading. So they really don't stop fully trading. They just reduce the volume, so it's still trading, but you can see a nice upscaling equity curve, and then it just stops. And what they do it with many accounts. So what they show you in the internet on your on the statistics, they show you their most profitable statistics. So out of 10, maybe there's just one that was very profitable, and they hope that you will invest into this. And that's one of the major scam. Okay. And there's another one, if they just do very small volumes on demo and very small volumes in pips, of winning pips, it is impossible to copy this. It's on demo, and they do it with a counterpart demo account. So they deal with themselves, and they just show you not the losing account, they show you the winning account. And that's the high risk.
Okay. Bernhard, thank you very much for your insight.
Thank you, Sam.
And thank you for watching. Be sure to click back to Dukascopy TV for more updates and exclusive interviews. We'll see you next time.